You know, there was a little bit of a hit in terms of volume. If you talk with dealers, they'll tell you that, Sarah, the cold weather, especially towards the end of the month, probably kept the crowds down a little bit. But those are not sales that are going away completely. Simply means most of those people would likely be back in February. Overall, and remember, we don't hear from GM and Ford on a monthly basis anymore. Here's what we're seeing from the other major automakers. And most of these sales, by the way, for the month of January, compared with January last year, were in line with expectations, maybe a smidge under what people were expecting. Overall, the sales rate for the industry in January is believed to be coming in somewhere between 16.7 and 16.9 million vehicles. For a point of reference, last year we were actually up slightly compared to 2017, and the total sales rate was 17.3 million vehicles. A couple of stocks to keep in mind. First of all, Fiat Chrysler, which still reports on a monthly basis, reporting Ram pickup sales up 19%. 19% last month. That's an indication of how much demand is out there right now for pickup trucks. By the way, Fiat Chrysler reporting fourth quarter earnings on Thursday. And also take a look at shares of General Motors. It reports its earnings next Wednesday. Guys, GM is also in the process of finalizing the job cuts that they announced back in the fourth quarter. Some of those are now going through in the next couple of days, over the next couple of weeks. These are the white-collar job cuts. The ones who have already taken the voluntary separation, those have already basically been meted through. Now it's the involuntary job cuts that are going through, and that'll get some attention over the next few days.
Phil, stay with us. We're going to continue this discussion and bring in Jamie Albertine from Mile One Auto Group. Jamie, good afternoon to you. Thanks for joining us. So I guess, firstly, on this monthly data, year over year, we are looking at a slight decline, certainly for new car sales. But was that to be expected?
Yeah, well, first of all, Will, thanks for having me, and good to be here with Mile One now, working on strategy and corporate development. And as I'm immersing myself more in the dealerships, we're seeing the retail sales trends are, as you said, sort of flat to slightly down. But there's still lots of opportunities to take share. In fact, Chevrolet in the Mid-Atlantic region where we operate actually did quite well this month. So, Phil talked about weather trends being sort of a negative impact more broadly. It was a little bit less so on the East Coast. Federal government had some impact as well. Some of that we expect to maybe come back in February, so not all lost at this point.
So, Phil, I'm just looking at the share price performance. I mean, they've come roaring back to life a little bit this year after underperforming last year. I think the Auto Group is up 14.5% so far. What are the prospects like for the rest of the year? We can continue to get numbers like this to keep boosting the share prices.
It's a little bit muddied. In part, the reason why is because you have some companies like General Motors, which have already laid out their guidance for 2019. And they said, look, we plan to be growing our revenue and our profits X% in 2019. And then you have others like Ford, which have come out and they're not giving guidance at this point. So while we have seen the shares rebound a bit, keep in mind there was a lot of pressure built on the auto stocks, particularly in the third quarter of last year. So even though January was better, I'm not sure you can extrapolate that for the rest of the year.
Jamie, does a pausing and dovish Fed increase the likely demand for the broader sector, or were rates and availability of finance not really a problem anyway?
That's a great question. We've seen rates widely available, or I should say credit widely available across all credit classes. And when you couple that with inventory being relatively lean, these aren't the concerns, considering how late we are in the new vehicle sales cycle and we're clearly at more of a plateauing phase. It's good to see that credit is still holding up. So don't see that as a concern. If anything, that should allow consumers to get into sort of these increasingly more expensive trucks and utility vehicles as they shift more away from cars.
So what's your expectation, Jamie, from your new post about what 2019 holds?
Sure. I think, for dealers that have capital to put to work like ourselves, it's going to be a consolidation year. We're seeing the M&A pipeline really build. So it's good to be in a strong position from a balance sheet perspective. We're taking share in our core markets. It's definitely more of a grind on the new vehicle side. But looking to used retail, the finance and insurance business, there's always opportunities to do better there. And look, we're in a position where, technicians and salespeople, there's a shortage broadly across the industry. So there's more of a race for talent as well. So I think if you're in a good position with capital and talent, you can do better in a slightly declining retail SAR environment.
And just to confirm, Jamie, the new post is Vice President at Mile One, not at the White House.
As far as I know, that's exactly right. Exactly right.
Yeah. deceptive shot.
Deceptive background there for you. Phil, just quickly, what are we looking at for the week ahead in terms of the autos data and earnings-wise the next couple of weeks?
Well, you've got GM on Wednesday, Fiat Chrysler on Thursday, and for both of those companies, the big focus is going to be the rest of 2019. We already have the guidance from General Motors. They gave it to us a couple of weeks ago. That's the reason the stock moved higher. On Thursday, let's hear what Mike Manley, CEO of Fiat Chrysler, has to say about further investments to add more assembly lines, more capacity as they continue to expand that Jeep line.